Hello friends, today I am going to analyze SBI Cards company, which is the second largest issuer of credit cards in India, and I will also tell you the reason why this company has a great potential to become a multi-bagger stock of the future. So just sit back, relax, enjoy and watch this video till the end. My name is Karthik and my mission is to spread the knowledge about the world of commerce under one umbrella, which is Combrella. So friends, SBI Cards company was launched in the year 1998 in New Delhi, and right now it is headquartered in Gurgaon, Haryana. Okay, and it is a subsidiary company of State Bank of India, SBI, which is the largest bank in India in terms of balance sheet and the number of customers. Okay, and this company SBI Cards also came for a IPO just very recently, 2 years back in the March 2020, just before the pandemic and the lockdown, and the IPO size was 10,355 crores. Okay, and it is one of the biggest IPOs in India till date. So friends, to know more about the company, we need to understand the revenue model of the company, and which is very simple. The revenue model is very simple, but also it is very important to know. Only then you will understand how a credit card company actually operates and what is its business and revenue model. Okay. So friends, the company has 5 broad sources of revenue. The first one is interest income, which constitutes 53% of its total revenue. Then you have income from fees and services, which is 42% of the company's revenue. Then you have service charges, which is just 1%. Then you have business development incentive, which comes to 3% of the revenue. And then finally, insurance commission services, which is a very small percentage, less than 1%, very negligible amount. And now let us understand each of these revenue streams in detail so that you will understand about the company. The first one, interest income. So company earns interest on various types of services or products which it gives to the customers. Okay, let us take the first one on EMI transactions. So if you buy something on EMI using your credit card, say for 3 months, 6 months or 9 or 12 months EMI, then on that EMI you will have to pay interest rate or interest based on the percentage of interest, right? So that is one interest which company earns from the EMI transactions. So hence on EMI transactions the company earns interest. Then second thing, if you get your credit card bill every month, you would have noticed that there is a minimum amount which you need to pay in your credit card, right? Say suppose for example the credit card statement for this month has a total amount is 10,000, minimum amount suppose if it is only 2,000, okay, and if you pay only 2,000, then the balance 8,000 rupees is considered as a loan, and on that also you will have to pay interest to SBI Cards, and that is another form of interest income to the company. Third one is, say if you have a SBI credit card, you can go to any ATM, okay, and using that SBI credit card you can withdraw cash from the ATM, and the cash amount which you have withdrawn is nothing but a loan given by the company. So on that there's transactions also you need to pay interest to the company. Okay, so these are the basic 3 income streams as far as interest income is concerned for the company. Okay, now let us understand income from fees and services. Okay, in income from fees and services, the most important is interchange fees, friends. Okay, so what is this interchange fee? So actually in this entire transaction, okay, there are 5 parties which are involved in this transaction. The first one is you, the customer. Second one, okay, is a shopkeeper. And then third one is the credit card company which you have, right? If you're having a credit card of SBI Cards, the SBI card is the third party, and the name of that party is known as issuer. It has the issued credit cards to you, so it is known as issuer. The person who issues the credit cards is known as the issuer, in this case SBI Cards. And then the fourth one is the bank of the shopkeeper, right? The POS machine which is connected and on which you will swipe your credit card, that POS machine will be linked to the bank account of the shopkeeper. So that bank is known as the acquirer. Okay, that is the fourth party. And then finally the network, which, or the platform which enables you to make this transaction go through, is the fifth party, which can be Visa, MasterCard or RuPay, which is written on your credit card itself, Visa card, Master credit card, right? So that is the fifth party, which is known as the network. So these are the 5 parties which are involved in a credit card transaction. So what happens when you go to the shopkeeper, when you pay anything using credit card, say for 100 rupees, out of that, let us take a commission of 2%. Generally, the commission can vary from 1.5%, 2% or 2.5% also, but on an average, generally the commission is around 2%. So out of this 2%, a major portion of this commission will go to the issuer, that is the SBI Cards. Okay, and balance will only go to the acquirer and the network partners. Say out of this 2 rupees commission, 1.3 or 1.2, around somewhere around 1.2 to 1.3 rupees will go to the SBI Cards company, and the balance 0.8 or 0.7 that will be shared between the acquirer and a network partner based on whatever the percentage is. So this major portion of the commission goes to the acquirer, which is the SBI Cards company. Okay, so this is how the transaction happens, and that is how SBI or any credit card company earns revenue from all the spending which you do. Okay, then in this the company also has membership fees, which is the second stream of revenue under income from fees and services. So in membership fees, if you see friends, there are a lot of high value credit cards given by the company, right? SBI has SBI Platinum cards, SBI high value, top platinum, gold, or rewards credit cards. So for all the high end credit cards, you will need to pay membership fees annually to the company, and for that membership fees the company will give you, like say free movie tickets during the year, or travel, or some restaurant you can go and have it. So that is the advantage of getting membership credit cards. So that is also one form of revenue which the company gets from membership fees. Then there is late fees. Okay, the third one under income from fees and services. If you don't pay credit card bills on time, then company will charge you late fees. And then finally annual fees, right? Annual maintenance fees you might have to pay to the credit card company for the annual maintenance, right? So these are the 4 transactions in income from fees and services. Then the third stream of revenue is service charges. What does this mean? So basically friends, if you see, SBI Cards has partnership and has co-branded with other companies also, like BPCL, Bharat Petroleum, for petroleum credit cards, or Tata company, or Chennai Metro, Delhi Metro, or various lifestyle brands such as Ola and other things. So for all these co-branding and partnerships, the SBI Cards earns some service charges, which is just 1% of its revenue. Okay, then we come to the fourth one, which is the business development incentive. What is this? Basically, SBI Cards has entered into long-term contracts with various network partners such as Visa, MasterCard, for various programs designed to build payments volume or increase the product acceptance. Basically, to develop the credit card ecosystem in the country, it has entered into contracts so that more and more POS terminals, QR codes, or credit cards are accepted by various people or shopkeepers, merchants in the country. So for that, it has entered into contracts, and if it achieves the target, on that target, the company will get some incentive, which is around 3% of its company's revenue. Okay, and then finally, the company has insurance commission, which is basically company acts as a corporate insurance agent for selling insurance policies to credit card customers, right? Which is very small, less than 1%, negligible. Okay, so now I hope friends you understand the company's revenue model, how does the company operate, and its business model is very much clear to you. So friends, now let us understand the macroeconomic factors which affect this company and the industry of credit cards as such. So friends, let us now look at the opportunities available in this industry. If you see friends, Government of India is pushing very hard and fast for digital India, cashless economy, right? We all know about that government's effort. So that is going to be a very much positive sign for the credit card company if it wants to go digital and cashless. Second thing friends, second big opportunity is India is a highly under-penetrated credit card market as compared to the world. Okay, so if you see the average credit card ownership in India, for every 100 people, is only 4, which means for every 100 people, we have only 4 credit cards in India. And if I tell you the statistics of other countries, you will be shocked. Okay, Russia has 26 credit cards for every 100 people. China has 53 credit cards for every 100 people. Australia 79 cards, UK 92, Brazil 105, and the topmost USA 331 credit cards for every 100 people. Imagine. So you can imagine the amount of opportunity or the market size which is available, untapped market potential which is available for SBI credit cards, friends. Okay, so that is a great opportunity. Third thing, friends, is the e-commerce, which is estimated to grow to $200 billion plus by 2026 from $64 billion in 2020. Okay, friends, so if you are banking on digital India, formalized economy because of e-commerce, right, then SBI cards can give you huge returns. See, friends, because of this formal economy, e-commerce and more formalization, what happens is now you are even paying for taxi, auto through Ola, and you are buying even vegetables, milk from Big Basket, groceries, right, all using credit cards. If not for this formal economy, you would have paid everything using cash. But now you are paying everything using credit cards. So as economy becomes more formalized, credit cards will be used more, and it has advantage to the SBI credit cards. Fourth opportunity is SBI's customers, the parent company. State Bank of India is the largest number of customers it has on its bank in India. Even if 50% of the customers of SBI become SBI cards customers, you can imagine the amount of opportunity which is available to SBI cards. Okay, friends, so these are the 4 opportunities available to the company. Now let us look at the threats or the challenges which the company has. Okay, the first one is the UPI. UPI, friends, is the biggest technology digital revolution in India as far as payments is concerned. We all know that, and right now everywhere, right from tea shop to big showrooms also, UPI is accepted. So that is kind of a challenge for SBI, as a credit card company. Okay, because people have started paying for UPI, even from 150 rupees, 100 rupees, 200 rupees. But also you have to note that UPI is used only for smaller ticket purchases, right? Whenever you want to make payments of 50 rupees, 100 rupees, 150, 200, that time instead of paying cash, generally people prefer to make UPI payments, right? Even I also, whenever I want to make any payments above 500 or above 1000 rupees, that time I would only prefer to make credit card payments. Okay, so there is a plus and minus side also for UPI against UPI as a challenge for the company. Right, friends? Second thing is the growing knowledge about, knowledge and awareness about using credit cards properly. There are a lot of videos in YouTube, social media, a lot of social media finance influencers are creating videos after videos that, pay credit card bills on time, don't spend overly or too much in your credit cards. So a lot of education, awareness, knowledge is being, said in the social media circles. So if it becomes like that, then people might not take a lot of interest or EMI related transactions, so that might come down. Okay, it might come down, but it will not go drastically to zero. Okay, so you have to understand that also, friends, because USA, highly educated country, still 300 credit cards for 100 people. So it will kind of this, we'll have to see how this impacts in the future. Third thing, the third threat is, friends, the BNPL, buy now pay later fintech startups which have emerged in the country rapidly, like UniPay credit cards or Slice credit cards or Zest Money. What do? They give you interest-free EMIs for 3 months, 6 months, okay, and give you cashbacks offer also. So that is a kind of a challenge, which company, SBI credit card company, will face it, and we'll have to look out for it, how the company performs and how does this entire scenario works out. Also understand that not all the fintech companies will become great or will generate huge revenue or profits. That is a big question mark. These are startups, money is pumped in. Whether they'll generate revenue or profits, only time will tell. Okay, understand that. And also important thing, friends, SBI credit card, suppose if it also does BNPL, buy now pay later, it will kill the competition of all these BNPL startups which are there, right? So we have to see how the situation improves over the next 1 to 2 years. So these are the the threats which the company faces. So now friends, let us understand the financial part of the company, the financial analysis, revenues and profits. Okay, so all the numbers are in crores and it is a standalone entity. There is no consolidated financial statements of the company. So all numbers are in standalone numbers and all figures are in crores. If you see the revenue of the company, friends, for the year ended March 2021, the revenue of the company stood at 9,277 crores. And if you see the last 5 years CAGR, the CAGR has been 23.43%, the rate of growth of revenue last 5 years. Okay, in spite of the fact that revenue did not grow much in the financial year 2021 because of the pandemic. Okay, so good rate of growth, I would say, for revenue 23%. If you then check the PAT of the company, profit after tax, for year ended March 21, it was 985 crores, less than March 20, which was 1245 crores. But if you see last 5 years CAGR, okay, the growth rate, the PAT profit growth rate has been 20.32%. Okay, again, good rate of growth in profits of the company. If you see the current financial year, friends, financial year 21-22, for the 9 months ended 31st December 2021, revenue of the company has been 7,827 crores. And if you take the previous December 31st December 2020, revenue was 6,977 crores, and December 19, 9 months if you take, 6,843 crores. So if you see, friends, the company's operations and revenue have now crossed the pre-pandemic levels also. So it has come back to the normal. If you look at the PAT, profit for this 9 months ended December 2021 is 1,035 crores. December 20, it was 809 crores, and December 19 was 1,167 crores. So profit needs to come to the pre-pandemic levels, but operation-wise, company has come back to its normal levels. Let us now look at another important metric, which is the NPA, non-performing assets. Okay, if you see the gross NPA of the company, friends, last 3 financial years, March 19 was 2.44%, March 20 2.01%, March 21 5% gross NPA. But if you see the NPA, gross NPA on December 2021, this year 9 months ended, it is 2.4%. NPA has come down significantly, drastically, and near to pre-pandemic level. So very good positive sign for the company. And December 21, if you see the net NPA of the company, it is only 0.83%. Right, now what does net NPA mean? Net NPA is nothing but gross NPA minus your provisions is the net NPA. What is that? So if you say there are bad loans on which the company feels it will not be able to recover the money, if it is 100 rupees, on that if the company has created a provision, say for 98 rupees that it will not receive, the 2 rupees is actually the net NPA. So 100 is gross NPA, 2 is the net NPA. Okay, which is now 0.83% of the company only, right? Great sign. If you look at the cash flows of the company, March 21, it was 127 crores. Before that, negative 218 crores, 422 crores, 304, 26 crores. Okay, so cash flows have been erratic of the company. This is a net cash, from operating, investing and financing activity. It has been erratic, but it has been decent, not exceptional, but decent enough. Then if you look at the EPS of the company, friends, March 21, it was 10.48. Last 5 years CAGR has been 16.09%. Okay, so good rate of growth in EPS of the company also. Now friends, let us look at another important ratio, which is return on average equity. If you see 31st March 18, return on average equity was 31%, March 19 28.4, March 20 27.9, and March 21 16.6. So return on average equity has been declining continuously, but average of last 4 years has been 26%, decent enough. But if you see return on average equity on 31st December 2021, the latest figures is 20%. So company has, I would say, good return on equity, not exceptional, very, very high like 25, 30, 40%, neither very low, decent return on average equity, friends. Okay, this was the financial analysis of the company. So friends, let us now look at some operational metrics and data of the company. And the company has actually a very strong operational advantage in the market of credit cards. Okay, so if you see the number of credit cards in force, the share of company SBI Cards in the number of credit cards which are there live in the market, as on November 2021, okay, if you see, the company has 19.2% of credit cards in force out of the total credit cards which are there in the country. 19.2% as on November 2021 as per the RBI data. And if you take the last 3 financial years, financial year ended March 21, 20 and 19, the share was 19.1%, 18.3 and 17.6%. So the share of the company has actually been continuously increasing, and that is why it is the second largest credit card company in India in terms of market share and other things. If you take the spends, market share of the company in the spends category, that is out of the total spends made by the credit cards, what is the share of spend of SBI credit cards? Okay, if you see again as on November 2021, it is 19%, okay, which is the second largest share. And last 3 years, if you see financial year 21, 20 and 19, it is 19.4, 17.9, 17.10. So good share, continuously increasing share, and second largest, I would say. And if you take another metric, the transaction share of market share of SBI cards in the transactions out of the total number of transactions of credit cards which happen in the country, what is the share of SBI cards? Again, as of November 2021, as per RBI data, it is 20%. And last 3 financial years, if you see, it is 19.7, 17.7, 15.8. Again, that is why second largest issuer. And that, if you see friends, another important factor, number of credit cards which are in force as on 31st of December 2021 of SBI cards is 1.3 crores friends. Okay, so that is why it is the second largest issuer after HDFC Bank credit cards. SBI cards comes second in the market category. Then let us now look at the valuations of the company, friends. If you take the market price of the company as on 12th February on the date of this shoot, it is 844 rupees. And if you take the 31st December EPS of the company, which is around 11 rupees, the PE ratio comes to 77. Okay, and the market cap of the company is approximately close to 80,000 crores. Okay, and there is no other listed company in this credit card space to compare the PE ratio of this company with another company. But generally, if you see, the PE ratio is a little bit on a higher side. The companies such as big companies like Reliance, Infosys, all these companies have PE ratio of 30, 35, 40 only. So compared to that, this is a little bit higher PE ratio. But the important thing, friends, is to note is that I would say that in the conclusion that this company is into sunrise sector. Sunrise because it is digital economy, cashless economy, and it has a high market share in this credit cards, and also the support of SBI, the parent company. If the customers of that come here, great advantage. So it is a very good industry, I would say, very interesting industry, the new age industry, the future industry, it is there, and hence the PE ratio can be high, but you have to see what it can go to the future, right? If 80,000 crores becomes 1,60,000 crores in future in 4-5 years, amazing. So only thing is it needs to establish itself against the competition of this BNPL fintech startups, buy now pay later. If it does, then I think surely it can give multi-bagger returns in the future. So I would say follow this company, do your own research, and then invest. And I think it's a good company to invest. Definitely you can check this upon. So with that, we come to the end of this video, friends, and I hope you all liked this video. If yes, then please do share it with your friends and let me know your thoughts in the comment section. I will see you all in the next video. Until then, this is Karthik signing off. Thank you and namaste.